The following is a presentation of TFNN.
Hello, everyone. Hello, and welcome to TFNN. This is the Option Hour with Victor Jones. Thank you, everyone, for tuning in. Obviously, we have a very interesting market day today. We are currently down on the S&P 500, $35. We are trading at 1214 half on the S&P 500. For those of you who follow the Dow Jones, and again, I'm quoting the futures product, obviously here, the Dow Jones is down $292, 11,607. So, obviously we have a lot of volatility in the market here today. The VIX has gone, if you remember, we almost settled near the 24 level a couple of days ago. We are now up to $37.22 on the day, up $7.26. All right, that's your market update. Again, this is the Options Hour. For the entire hour, we're going to be talking option strategy. So clearly, we have had a level shift here today, and heading into November expiration, you may have a lot of questions, maybe how to manage positions, or, we're still right in the thick of earnings season. So we've had a couple of people come out, and, Pfizer early this morning, and, we've got, I believe, Valero and Marathon. We've got a couple of energy companies coming out today. So, a lot of earnings plays out there. So whether or not you want to talk about managing your current position, putting on a new one, please give us a call at 877-927-6648. Again, guys, TFNN Option Hour, it's 877-927-6648. So, again, just kind of jumping into the market. We've been all over the place. We're just actually settling into Chicago here. We were in the fine city of Russia over the last week, St. Petersburg, beautiful city in Russia, visiting the Hermitage Museum and all other types of historical landmarks. It was actually a very, very beautiful place. And upon return, what do we see? This Saturday was the 82nd anniversary of our 82nd anniversary of the Black Tuesday 1929 market crash, and Monday and Tuesday are definitely setting up to be observances of that very event. I mean, if we look at what we saw over the last couple of days, again, I'm just looking at the spiders now instead of the S&P futures contract. But essentially, this, spiders were now trading at about 122. And I spoke with a couple of people at the beginning of this expiration cycle. If you really looked at what the probabilities were that we hit 126 or 127, the probabilities essentially were 70% that we would not touch those numbers. And we had a significant rally at the end of last week, and that some even Nesto on CNBC, whatever financial news you're listening to, a couple of people basically essentially deemed that as a dead market rally at the end of last week. Regardless of the market events, and here, if you're looking for a quick update on what's actually maybe causing some of the volatility, but essentially, we've seen a meltdown in the company MF Global Futures clearing firm, and we're also seeing obviously today, in terms of what we're seeing, overseas, basically the news came out that we're looking for, essentially a referendum. The Greek government struggles after, we've kind of had last Thursday that agreement to write down about half of that debt. So all of this coming together is giving us, obviously a little bit of volatility. Let's take a step back really quick before we start taking questions here. But essentially, we've got a lot of economic indicators. We've got the Fed meeting here starting today. We've got the G20 meetings Wednesday and Thursday, and we've got the unemployment numbers on Thursday. So a lot of economic indicators here. We're going to go ahead and take our first call. We've got Frank from Quebec City, Canada, who has a question on multi-legged trades. Frank, are you there?
Yes. Hi, Victor.
How are you?
All right. How are you?
Good. Thanks for asking. What can we do for you, Frank?
Yeah, first, love to show you and Don do a great job. It's always Great show to listen to. Kind of got a nuts and bolts question. I've dabbled in options before. I feel that for the past year I've done a lot of education. I think I have a good feel actually from paper trading and all that for all the Greeks and everything. But I've got a really basic nuts and bolts question on, for example, if I have a call calendar at for XYZ's at $100. I have let's say 10 call calendars for it. It goes to 102, and for example, the short calls get exercised. And it's really a basic question, but it feels like I would have to provide, let's say, $102,000 worth of stocks because I have those long calls. But how does that work? Like, do I get I have let's say a $20,000 account. How does that work? Do the longs automatically get exercised at that point?
Yeah, that's a great question. I think it kind of depends on the firm, but from our perspective, right, if you essentially are assigned short stock but you have long calls, there's a couple of different things there. One is what's the regulatory risk or regulatory margin requirement, and then what's the real risk margin requirement, right? Because essentially that long call at 120, when you're short at 122, you essentially got the $2 worth of risk there, right? So from the firm's perspective, yes, we could automatically exercise that 120 call and for that position, but essentially if you're using some sort of risk-based margin system, so for instance, at our firm, we offer a risk-based margin to our customers, and if that's something you're actually utilizing, well, we're going to assess the actual risk of that position versus the regulatory margin. If the question specifically is from a margin perspective, how would the firm respond to something like that? And is that the question there, Frank?
No, it's more actually like, so I have $20,000 in the account, and my call calendar is $2 in the money, quote unquote, so at 102. And yeah, I get I need to provide the short calls. I need to provide the contract. Yeah. So what do I need to do anything, or do my longs automatically get sold to fulfill the shorts, or or is that automatic?
Well, it's not technically automatic. I mean, so there's a couple of different parties here, right? You being the trader, and then there's your firm, and then there's the actual clearing firm, the OCC. So the OCC just assigns it to the firm. The firm passes that assignment down to you. Now it's up to your account whether or not you have the ability to maintain that position. So the marketplace doesn't know you have a calendar on. They just know individual legs. So they'll assign out that individual leg, and then it's the firm's responsibility based on the margin required for the position to say, okay, do we want to automatically exercise this? So if you're talking about early assignment, then know that that long 120 call would not automatically be exercised. It would be up to the firm and you at that point on whether or not you actually wanted to go ahead and exercise based on what the account looked like versus the margin required.
Great. So how does that work? Do I get an email, or I just look at my account? What if I go on a 4-day vacation on that day, and don't look at my account? Is that something at the end of each trading day? Let's say I'm with ThinkorSwim. ThinkorSwim would look at my account and say, okay, this guy needs those 10 longs to get exercise or not.
Right.
Or is that something I manually look at my account and say, whoa,
in our case, we give out, at ThinkorSwim, we give out assignment and exercise notifications. So if you are assigned on something, you would receive an email. You would know the state of your account. In addition, our risk team would reach out to you and see how we wanted to take care of that. But again, from a risk standpoint, if you're short stock at 122. Your long stock at 120, essentially, for every dollar that goes up, you'll lose on the short end. But again, you're going to, you'll from a risk perspective, you're going to make that money on the long 120 call. So from a risk standpoint, it just depends, I think, on the state of the account. But we would give you a call, and again, you would have an email notification letting you know.
Yeah, okay, great, because I understand the risk, and yeah, I'm only worried about that $2, but from a, something that you never hear from when you don't, actually participate, in trades like this, and, that never gets covered. It's kind of a nuts and bolts. So it's good to know that, you'd get contacted, and at that point you kind of make a choice. given the state of your account, how to fulfill it.
No, Frank, and
Great.
it's a great question because I think it's going to transition us into talking just a little bit about calendars. I think whenever you see a large bump in volatility, the question always becomes, how do I either take advantage or how do I use calendars? Should I use calendars in this type of volatile environment? So I think it's a good transition into what we want to talk about here today, which is this volatility that we've been seeing in there. So I appreciate the call, Frank.
Thank you. Great show again. Thanks.
Thank you. So again, Frank brings up a really great question, and it's from an option trading perspective, it is something to be aware of. I mean, if you're essentially putting on a calendar spread, and for everyone out there to walk through the construct of what that actually means. Essentially, you're selling either a call or a put. You're selling an option in the front month, and you're buying an option of that same strike price in the back month, which would be an actual calendar spread. And typically what that allows you to do is take advantage of volatility because you're going to have a little bit of a volatility differential between the front month and the back month. And typically, the relationship of these different option series is that the back month is going to have a little bit more sensitivity to increases or decreases in volatility. And I want to show everyone exactly what that looks like because sometimes that's an interesting concept when we say it out loud, but to see it visually I think sometimes kind of drives that home. So if you're watching us in the webinar or you're on the Tiger Den, we appreciate it, and feel free to follow along. But I want to explain this for everyone that's out there. So I'm going to show something called Vega. And Vega is an option's sensitivity to increases or decreases in implied volatility. So if I have an option that has, let's say, a Vega of 1, right? For every 1% increase in implied volatility for that option, we'd expect the actual option price to increase by $1. So I'm jumping back to the screen here of the spiders. We're just looking again at the S&P 500. On the left-hand side, we have the call Vega. On the right-hand side, we have the put Vega. So essentially, all we're doing is we're saying, you're seeing at the bottom of this chart, you're essentially seeing the curve, the skew of these options, and how sensitive they are to volatility. And the white line essentially is the upcoming expiration, is November expiration. Actually, it's the weekly expirations, and then as you go forward, it's expirations out in time, and you can see. As you go further out in time, these options have greater sensitivity or larger Vega, meaning they will move more for each 1% difference in volatility. So what we really have to understand when we're putting on a calendar, right, that essentially means, and I'll just use this here, I might be selling this 100 call, okay, and I would be buying this 100 call in the back month. And you can see that difference between volatility, meaning, if volatility drops 5% or volatility increases 5%, because I'm long more volatility, which is that back month, I would stand to, in most cases, bring in a little bit of money based on that volatility difference. So essentially, a calendar is a volatility play, but how does that work into situations like we've seen over, the past 2 days, where the VIX has essentially moved from $24, and I'm going to call that 24. It's really about $24, and let's call it on the low $24.50. So $24.50 was the low that we saw on Friday of last week. Now we're trading at $37. So we've had a very short-term spike in the actual VIX. So what does that mean in terms of the option series that we have out there? Well, we always have to be cognizant of volatility differential, or the differences in volatility from a front month and a back month perspective. If we look at November, volatility is about 38.5%. If we look at December, volatility is about 36.5%. So we're really only seeing, at least in these indices, we're only seeing a difference of about 2% in volatility from the front month and back month. So it's not a situation where we saw in 2007, 2008, where we saw these significant short-term increases of volatility to, let's say, 90, 100, 120%, and the back month was still, somewhere around 60 or 70. This is a very consistent move in volatility, meaning the risk of, just the front month increasing where you're actually short the option, which would hurt you in a calendar spread, is a little bit less. So you do have the potential, again, to put on calendar spreads in either of these indices or underlying securities, both on the call and put side. Talking about construct of calendars. We have to look at the relationship between the market and volatility. Essentially, when we see a move to the upside, what do we typically see in volatility? Well, we see a contraction. And when we see a move to the downside, we obviously see an expansion of volatility. So if we are expecting a further increase in volatility, well, what would we want to do potentially with our calendars? Well, maybe it makes sense not to put on an at-the-money calendar, but maybe, put on a calendar that's skewed a bit to the downside if we are, expecting a continuation or expansion of volatility, which in most cases a calendar is going to be a positive Vega trade. So for those of you out there, and this has continued to be a very hot question over the last couple of days when we see, these volatile moves, how do we typically construct this calendar? Well, essentially here where you have that relationship between volatility and the underlying security movement, you might be looking at positioning that on the downside with if the expectation is continued bearish movement and increases in volatility. With that, let's go ahead and talk about a few names that are out there after we do a quick market update. The S&P 500 futures contract currently down $36. We're at 1213. The Dow Jones Industrial Average is now down $302. We are at $11,591, so we just broke 11,600. And the VIX, again, to quote that out for everyone out there, is 3710. We're up $7.14. That is a 24% increase following yesterday's move of a 22% increase. So, guys, volatility obviously moving up substantially over the last couple of days. And I want to talk about, obviously, a couple of names that have been out there. One, Starbucks. I mean, if we look at essentially what Starbucks has done today, we are down almost 3%. And, that's pretty much in lockstep with the overall market. I mean, the S&P is down right around 3%, but Starbucks, obviously, on the earnings news that we have coming up, in addition to Pfizer, so on and so forth. So we actually have earnings here coming up just a couple of days. It's going to be after market close here on Thursday. So we wanted to quickly point out the information or the earnings information that options are telling us right now. So if you look in the upper right-hand corner of my screen if you're watching, but essentially the options are priced such that it's indicating about a $2.37 move on earnings. Now, what does that mean? If we look essentially at the premium that's priced into these options front month versus the back month, so we're looking at Nove versus December here today. Nove currently trading at 51.5%. December options trading at 45%. So we've got about a 6.5% volatility differential. And if we kind of take a look at what that's telling us, it's about a $2.36 move that we may be expecting come Thursday. Now, clearly, we don't know, options aren't going to tell us a bias here, but they are going to tell us, again, the magnitude of movement. We can get that out of implied volatility. So if expecting a $2.36 move, where are the opportunities? And, we've been really monitoring essentially the volume that we're seeing in the November options, because the event is obviously taking place in November. So if we look at calls versus puts here, we're seeing we're a little bit heavily traded on the call side versus the put side. And I can show the ratio in just a moment, but the heavy options are the 42 and 43 calls. I mean, that's the most open interest that we actually have is actually on the put side at around the 40, 41, and 36 strike. But if we look at what's actually happening going into earnings, we're seeing a lot of activity at the 42 strike and 43 strike. I'd be interested to know, how you guys are setting up, plays coming into this Thursday. Feel free to give us a call at 877-927-6648. But let's look at it from a technical perspective. I mean, essentially, we have seen over the last 2 weeks, we've been trading in a range from $41 to $43. Now, with this move to the downside, we've basically moved ourselves to the bottom of this range. We're now at 41.26, which is just about 25 cents over the 41 low I don't want to say low, but essentially a resistance or support that we've created over the last 2 weeks. So what does that mean? Where's the opportunity? Well, with this increased volatility, if we were to look potentially at what we could do on the upside, let's say, again, into this challenging economic environment with the Fed expected to not really do too much over the next couple of days. The G20 meeting will be very, very interesting, and unemployment there on Thursday. So a lot of economic indicators shaping up over the next 2 days. With this volatility, where can we look? Well, if you look essentially at the probabilities, and I'm going to bring them up for everyone out there, the probabilities that we actually expire above 43 is about 30%. So there's a 30% chance that we actually expire above $43 on expiration, November expiration. So what's interesting is there's the potential there, and I'm just pointing this out, obviously not a recommendation, but the 43-44 call spread is about 30 cents. It pays out 30 cents, meaning it essentially has a 70% chance of success. And it's at the, constructing something like that puts your break even at $43.70. So $43 has essentially been the resistance area on Starbucks, and 43.43 was actually the high of the year. So this potential spread, puts you at about $43.70 on the upside, and with that, your break-even is actually above the high going into earnings, and you're putting that at the bottom end of the range. So interesting kind of opportunities there. With that, we will talk to Bob in Indianapolis, who wants to talk about bankruptcies. Bob, are you with us?
Yeah, I just was curious about what happens, like MF Global is going through a bankruptcy right now. What happens to the options when they declare a bankruptcy, and then do you have to manually cash out on your puts?
Yeah. What's interesting is, for a lot of people, I mean, when we saw the whole deal with Lehman a few years ago, I mean, when we saw this happen so many times before, the question always is, hey, if I'm long puts, what actually happens there? And the equity would essentially be trading. I mean, the equity is still going to be trading even into bankruptcy. If you're aware, you just kind of slap the Q on the end, and as you go through bankruptcy proceedings, it's not an immediate procedure. So there is the opportunity again to deliver on those puts. So for as we go through these different bankruptcies, I mean, it's not a situation where you should shy away from trading options because you're concerned about the underlying equity. Clearly, the derivative or the option is a derivative of that underlying, and as long as you have that underlying that's actually trading, you'll be able to settle on or clear on that underlying option. But at a certain point, they'll stop listing those options at a certain point.
Mm-hmm. No, well, mainly I was thinking about if you already had if you had to put in play and you know, let's say before the bankruptcy and the price really fell fast, and you know, if you get automatically, I mean, when they, like, I bought a few stocks and they're you know, the stock wasn't any good anymore after the bankruptcy. I guess they, I don't know, they restructured or something like that, and they didn't, and so that was that on the stock.
No, I think I see what you're saying. So essentially, you know, if for whatever reason, I mean, this essentially happened so quickly, or something, you know, some meltdown happens in the underlying company so quickly, and I'm long a put, what would actually happen? So I'm long a put, which essentially gives me the right to sell this stock at some price. I would take in, you know, what would essentially happen in that case is you'd still have this underlying instrument, regardless of its value. If it's worth zero, it's still worth zero, but there's still the necessity to clear that potential trade. So you would still receive the credit based on the strike price, and you basically deliver worthless stock to someone. Does that make sense? I mean, you just essentially, the clearing firms would deliver worthless stock to each other, and so essentially that's how that would work.
Yeah. Well, essentially my question was, well, if it gets to that point, do they automatically sell the option for you, or if you miss out, do you lose out?
You know, would they automatically sell the option for you?
No, yeah. In other words, when it goes down to zero, will they automatically sell it for you, or if you go on vacation or something and come back and, you know, the option or the company's bankrupt and down to zero and no longer in business, do you lose the premium?
Gotcha. No, I'm with you 100%. So essentially, any option, if it's 1 penny or more in the money on expiration, if it's 1 penny or more in the money into expiration, it will automatically be exercised. So if you're long options and it's 1 penny or more in the money and you haven't notified the brokerage firm, otherwise, the option itself will automatically be exercised. So if you had bought puts, let's say at $100, and the company was now trading at $2 while you're on vacation, well, that option is $98 in the money. So what would essentially happen is the firm would automatically exercise, and you would receive the premium for that. So as long as if you're going into expiration, there's still the necessity to follow those same rules at the clearing level.
Okay. Thank you very much.
No, not a problem, Bob. That's a great question. And I think in this heightened volatility, you know, it's interesting that, you know, the types of things that we're thinking about, right? Because when we start to see this different volatility, you know, we are looking essentially at you know, what happens in these worst cases, which is exactly why the VIX has done what it's done, moved from 24.5 to the upside to about $37. Now, what's interesting, though, even though that we had a bearish kind of play on things like Starbucks, and I think we'll get into a couple of the financials as well, because it's interesting what we're seeing in that space and in that volatility. But we've seen kind of a bearish play on Starbucks, looking at that 43.70 break even if you are bearish going into earnings on Thursday. You know, but some people, you know, tend to be contrarian, and when you have a market that's down now $31, but we've recovered somewhat. When you have a market that's down $31 and the VIX up to 37, people start to think that actually builds in a lot of premium to your options. So we're now down at the lower end of this range at $41 in Starbucks, and if you felt this was an interesting value opportunity, let's look at where potentially you have the ability to actually enter into that market. And on the downside, because the puts tend to trade with a little bit more volatility, let's actually look what those probabilities look like if we switch that up a little bit. So on the upside, we could sell a call that gives us a break-even of about $43.70 and gives us a 70% chance of actually making money on the trade. And on the downside, if we look at that 39-38 spread, we can potentially get, let's call it about 22 cents out of that potential spread. So essentially that would give you about a 68% chance of profit. A 68% chance of profit into November. And with that, what does that actually mean? Well, if you were to actually sell this spread, excuse me, we've got some people typing in here. If you were to actually sell that spread, you are how far away from the market? Well, you're not at 39. Essentially, you're at $38 and 80 or 78 cents, right? So 38.78, which is almost $3 away from the market versus the 2 on the upside. So you have a little bit more room on the downside to get away from the current market because of that volatility skew, because of those earnings, and because of the heightened volatility we're seeing over the last couple of days. So if you are bullish, what's interesting is around the 39, around the 40 level would be an interesting entry point on Starbucks for those of you who are looking for a bullish play. So with that, we will turn our attention to Pfizer and just kind of look at what has happened on the day in the face of this heightened volatility. Again, 877-927-6648. We'll talk about options on the underlying indices. We'll talk about options on stock. We can talk about options on futures. Anything you guys want to talk about, we can talk about. So again, Pfizer today launched actually very, very favorable numbers. Unfortunately, with the market, they gapped down on open. They opened around $19.20 on the day. We opened specifically at $19.50. We traded to a low at $18.97, and now we are currently trading at about $19.50. So we've made a move up about 1.2% or so, about 25 cents. So in a day where the overall market is giving up 3%, you're seeing Pfizer kind of struggle on positive earnings to gain about 1%. But the difficulty here, and this goes to show that even though we're up about 1.25%, you had a gap down of about 19.15 is where we actually opened. Even in a positive earnings environment or even in positive information, you may not see the upside potential, the upside move that you may expect. And that's why we kind of brought up that bearish play on Starbucks, which could potentially be interesting if we start to see overall volatility in the underlying markets. That said, we want to take you guys to the S&P 500. We want to talk about the actual securities out there that have heightened volatility or more volatility than the rest of the market. So really quickly, we want to take you guys through our Sizzle Index stocks. We want to give you the top 10 stocks in the S&P 500 that are actually showing heightened volatility into today. So we're actually seeing a couple of interesting underlying securities out there. One being Yum Brands. I mean, they're trading at $52.62. They're down about $1 on the day. They're trading 7 times their normal option volume. If we kind of take a look at where that activity is taking place, guys, essentially, the activity level is taking place right at the 55 call level. So when it comes to Yum Brands, and again, obviously, what we're seeing here is less volatility in the front month than the back month. Well, what does that actually imply? When it comes to Yum Brands, you're seeing 33% in front month implied volatility and about 36% in back month volatility, which essentially means if you are looking at taking maybe a longer term bullish play with options or going long theta, it might be interesting to sell that front month to pay for some of the back month because you are paying a premium in the actual back month, guys. So let's actually look at a construct of a couple of different instruments. So we'll take Texas Instruments here. Excuse me. Let's go to Texas Instruments, which is actually trading at about $30. They're down 77 cents on the day, almost 3%, 2.5% on the day. And we noticed earlier that we are actually seeing extreme activity here at the 29 call level, which is very, very interesting. We're not actually seeing that same activity level and any of the surrounding strikes. So what that means is typically we're not actually seeing any spread activity at the 29 level in the NOV. Texas Instruments TXN is where that volume is taking place at the 29 NOV strike. And so we actually took a look at it on our charts to see where that volume was taking place. And it actually came through about 720 contracts were traded about 20 minutes ago. 720 contracts looks like on the buy side in Texas Instruments, the 29 call. So those of you, again, looking for interesting activity out there, always want to point that out for you guys, what's actually happening in those markets. We'll give a quick market update again before taking some more calls here, guys. At S&P 500, 1218.5. We're down $31 on the day. The Dow Jones, 11,637, down 260. We've made a strong rally of about $50 over the last couple of minutes in the Dow. We've made a move from down about a little over $300, now down just $258. And the VIX finally still trading 36.58. We've dropped below 37. We are up $6.62 on the day. So we wanted to talk quickly about, technical analysis, or the technical breakdown of the market, essentially that we're seeing. And, over October, for the October expiration, as all of you know, the month of October, we have made a move in the S&P of over 120 points. And in the Dow, we've made a move of over 1,000 points positive. So we made 1,000 points in the Dow. We made 120 points in the spiders. And over the last couple of days, obviously, we're giving some of that back. We're making a small retracement. And from a retracement level perspective, if we're looking at potentially selling puts or put spreads to nibble on this increased volatility, we want to look at where those support levels could come in. So you saw from a low, the October lows of I'm using the spiders here, 107.43 to the high of about 129.30. If we kind of look at what we've done, or those retracement levels that we've essentially seen, we are kind of expecting 121 to be a very, very interesting level, and not just from a retracement perspective, but essentially that's where the resistance was for some time over the month of July and over the month of August. So we saw a lot of resistance at that 121 level, and we think that's actually going to be a very interesting level, and whether or not we hold 121 as we struggle to break above it for so long. And, of course, I'm talking about SPY. If we flip that around to the cash index of SPX, that number becomes a little bit closer to, 1250. 1250 being that main number in the S&P, the SPX. So if you're trading the cash or if you're trading the ETF, that's going to be a very, very interesting number, and where we're setting up puts us right at support. I would mention, again, you're more than welcome to give us a call. You're listening to the Options Hour with Victor Jones at 877-927-6648. We can talk about anything, guys. We've already wrapped up, or we've talked a little bit about bankruptcies here, obviously with MF Global, and they're missing $700 million. The number earlier this week, or I believe yesterday, was $1 billion. That number's now trimmed to $700 million. But Bob in Indianapolis had some great questions on what happens to the puts. When a company starts trading next to nothing, and I mean essentially you still have an equity to deliver, and so the in-the-money amount is still applicable. And then Frank in Quebec asked a little bit about multi-legged trades. So we talked about calendars, but we've also talked about actually selling vertical spreads. Now, I'd like to talk about covered calls, because I think what has happened here is we've had obviously a level shift. We had a breakout from a technical perspective. And in that breakout, when we broke 1250, there may have been a lot of people that took on new long positions. We didn't see a lot of volume follow through with that move above 1250, which is why we're a little bit wary. I mean, we didn't see any increased volume as you would typically expect volume to carry through a breakthrough of resistance such as 1250. We didn't see that. But we know that there were some people that took on long positions. So how do we potentially start bringing in some premium and lowering our break-evens if we're talking about long stock out there? So again, in some of those blue chip names, obviously we've got Microsoft that we can start with. They're trading $25.99. They're down 64 cents on the day, but down 2.5%. So you're going to see, you're going to see a trend here. I mean, if the overall market is down a little over 2.5%, regardless of the performance of the underlying, you're going to see, typically the same thing. So Microsoft, again, trading about $26 right now. They're down 64 cents. What can we do potentially if we took these new long positions on the break even of 12.50? Well, you have the ability here to start selling some of the upside potential so that you can bring in some premium. So if you're long stock, I would encourage you to take a look at the calls, take a look at the implied volatility, and see what type of premium you can bring in. For instance, we're trading right around $26, and if I had a rather large position, December, which is 45 days out, offers to pay about 50 cents per share at the 27 strike. With Microsoft tending to be a relatively stable underlying security, or something that is relatively stable, you might not expect Microsoft to rally to the 27 level potentially between now and expiration. Now, we were just trading there, but we didn't really see a move above 27.50, so there might not be a lot of longs above that 27 level. So again, if it's an interesting place to potentially sell that upside premium and lower your break evens. So we will turn our attentions to the overall market. We want to go ahead and look at the NASDAQ and see what's essentially performing or underperforming on a day like today. Looking at the NASDAQ 100, the underperformers that we're seeing here are HSIC. HSIC, that's Henry Schein Corporation. They're currently trading $64.11, down $5. That's 7.5% on the day, guys. The only, I don't want to say the only, but one of the shining stars in today's market is Expedia, EXPE, and I'll pull that up for everyone here because I think it's interesting that we kind of take a look at what those options are telling us. And if we look at Expedia, not a lot of volume, I think, in the options market, but the underlying security, $26.74. They're up 48 cents on the day. That's about 2%. So a 5.5% swing from what the actual underlying market is doing. Sorry, guys. And so, again, just kind of looking at what's going on out there, but essentially hotels kind of increase. Basically, Hotels.com and Booking, things like that, have increased significantly in the first half of 2011. And there's been some consistent findings that they expect travel to rise about 9.2% throughout the rest of the year. With that, the prices of hotel room will rise maybe around 3%. So you're actually seeing demand there in that particular space pick up a little bit. Now, to give a little context around that, while consumer spending, at least in this space, looks to be picking up, we unfortunately saw that manufacturers are a little bit less likely to pull that trigger. So this morning we had construction spending numbers come out, which the actual number came in at 0.2%. The expectation was that we would come in at 0.3%. So, again, a 33% discount to what the expectation was, which is, again, adding to this heightened volatility. The last thing here, guys, as a quick update, is the ISM index came out this morning. 50.8 versus a number that was expected of 52.1. The prior number was 51.6. So again, we came under prior and we came in under expectations as well. So unfortunately, not a lot of good, strong economic indicators. And while a couple of underlying securities came in with some decent earnings reports, Pfizer being one of them, not enough to bolster any enthusiasm here. You're seeing that one of the additional kind of low flyers of the day is FSLR, First Solar. And if we kind of take a look at that market, guys, $46.77, down $3 on the day. That's 6%, a 6% move to the downside. And what's interesting here, if you look at the November versus the December, the implied volatility of this underlying security is at 108%. So clearly, a lot of premium is built into this underlying security. Now, the volume's a little bit light and the spreads are a little bit wider here. So I would caution you, if you're looking at playing First Solar based on the action that we're seeing and based on the volatility that's available here, you're going to see 10 to 15 cent wide spreads. So what is very important here, and if we kind of take a look at a quick chart of First Solar, we're trading right on the yearly lows. We're at about $46.83 on the day at a yearly low of $42.50. What does that mean to us? Well, if we see implied volatility of plus 100%, 110%, that means the stock could either be trading at 2 times its price in a year or at 0. And so anything above 100% is kind of interesting because that extra 10% is extra premium on the upside. I mean, you couldn't go 110% to the downside. You could only go 100%. So there's a little bit of premium priced into upside expectation. So it's interesting to, start nibbling on things like that. But again, the trend here in First Solar has been absolutely abysmal. We have made a low with that 42.5 level. So it's interesting if you're looking at that 42 level, what you can actually bring in from a premium standpoint. So if you were going to sell, let's say, the 42-41 spread, you take in 30 cents. So we know we have a 70% chance of profitability or potential profitability there. And how do we know that? Well, it's a $1 wide spread, and you take in 30 cents. So the risk is 70 cents. If we divide 70 cents by the real risk, which is 100, you'll see that 70.7 is what you get, and that's your probability of success with that trade. So again, the 42-41 put spread, again, you got to be pretty pretty courageous. But if the idea here is when you're seeing these high volatility numbers to go ahead and look for potential short-term bounce, well, the stock has shown you a little bit of support at 42.5. So 42.41 brings you in 30 cents and puts your break even at $41.70. To look at that, again, you have a little bit wide spread, so I would encourage you guys, take the midpoint of the bid and ask. Whenever you're looking at where do I execute an underlying spread, you want to take the midpoint of each leg. And especially in ThinkorSwim software, we do this for you automatically. But I want to show you when it comes to that underlying, the 42 strikes trading 216 to 223. That puts the midpoint between those, the mathematical average at $2.20. The 41's trading 185 at 193. The average between those is 189. So when you're constructing your spread, you want to take 219, which you're receiving the credit for, subtract 189, and your credit should be 30 cents. That's how you know where to at least start when it comes to working for execution. A couple of interesting plays there, but as we wrap up here, guys, any questions in summary on some of the underlyings that we've looked at today, feel free to give us a call, or if you're trading some of your own, 877-927-6648. S&P 500, just to give a quick market wrap, is down $36, 1213.75. The Dow is now trading 11,596, down 302. So we gave back that little mini rally of 400 points. And the VIX, of course, we have to keep quoting the VIX. 36.93. We're up $6.97 with an uptick to 701. We're now above $7 in the VIX. What I want to quickly point out as we wrap up the show here today is what's underperforming and what's outperforming in terms of industry, in terms of sector. So what I'd like to do is just show a quick comparison. We're looking right now at the SPY, an ETF that tracks the S&P 500, and I'd like to compare it with some other major indices out there. And let's go SPX instead. And I want to actually point out the differences in percentage performance over this last month, because I think it's very, very telling of kind of what we're seeing. So we've added the NASDAQ composite here. We also want to add the semiconductors, and we want to also add gold and silver, so we get a bit of commodities here. So if we look at essentially what we've seen over the last month, there we go, guys. If we look at what we've seen over the last month, you can see commodities have essentially, or at least gold and silver, have underperformed the rest of the market, up about 7%. And I mean, that makes 7.33%. That makes a little bit of sense because we've rallied, throughout the rest of the market. So I think the risk appetite was a little bit geared towards equities than it was to the underlying, gold and silver. And if we've seen what the SPX has essentially done, we've rallied about 10%, almost 11% over the last month. The NASDAQ, 11.5%. So we were actually leading. The NASDAQ was leading the market for a bit in terms of percentage performance. And now we're almost trading in parity over the last month. The last thing I want to point out is the actual semiconductors, guys, and the semiconductors are up about 14%. So I say tech in a general term, but I wanted to make sure everyone was aware of those semiconductors. So the volatility here today, and the volatility has been in the last couple of days in semiconductors. They made a move up to 22% and have now given back essentially 8%. And so if you're really looking and trying to break down this market and see where this give-up is, I think you have to look at the semiconductors. If you're in the semiconductors as well, at least from a long perspective, I think, it would be interesting to take on some repair strategies, whether it's a back ratio spread or whatever the case would be. But being long here is a little bit dangerous. I think you're seeing the correction more than anything else in those semiconductors. So with that, guys, we are going to be looking over the next week at the Fed meeting coming out. Not a lot of information expected, but a lot of signaling, no action rather expected to happen, a lot of signaling. The G20 meeting Wednesday and Thursday into those unemployment numbers will be very interesting. We've got some earnings announcements coming out. We had Pfizer today, Valero, Marathon. We've got Starbucks coming up in a couple of days. Very, very big names. So I would be cautious, though. All of the earnings and all of the economic impacts are creating this very, short-term inflation of volatility. And I think what will be interesting to see if we actually see this volatility into next week. And, do we think that volatility at this 40 level will last? Well, the VIX has shown you that typically at 46, it's a very, very short ride until we've settled back down around 30 or 25. With that, guys, I want to thank everyone for joining the Options Hour, TFNN, and we'll see you next week.